All right. I'd like to welcome everyone tonight. Thanks for popping on. I'm showing 18 participants so far, and there should be more of us joining. We had a total of 47 people registered, so hopefully a few more show up. So thanks everyone for taking the time on Tuesday night out of your busy life to join us. And I always like to introduce Tyler as a financial wizard. I love listening to Tyler's presentations. He does the prep and he walks the talk. He lives the life of the financial wizard. So again, thanks everyone. Tyler, I'll let you take it away.
Perfect. Thanks, David. Hello, everybody. So I live on Zoom a lot. So welcome to my meeting place and getting to go through this with you. So tonight we're talking about rental financing. And there's quite a bit of myths and restrictions or things that people run into that may or may not actually be there. And then there's some different programs. So today I'm just going to pull up my screen.
That's like 15 days.
And maybe I'll ask everyone in the group, you want to just click mute on your screens just so we don't have people talking over. So it might be May or somebody.
That's fine. You can have it in 2 weeks.
So anyways, today we've got some things that I'm going to go over. I'm going to share my screen real quick. This is just a little overview, and I'm actually going to start with so I'm a mortgage broker, own a company called Designer Capital with some partners. We're based out of Victoria, BC, and we're registered in BC and Alberta. We have two teams. We have a separate division that does commercial financing and a separate team that does residential. And I've been at this for 20 years, specializing in more complicated files. And how I arrived here was I was hired to work for the Bank of Montreal 20 years ago. I was selling shoes, and I sold shoes to the vice president of the Bank of Montreal. And she offered me a job. I sold her some really expensive shoes. And they came back maybe a couple months later with a bunch of bank managers, and I sold them all shoes a second time, 6 months into the job. And they said, you have to come work at the bank. And I said, I just don't want to be a teller. So I actually got hired off the street to be a bank manager. And so instead of learning financial products to do them, I had to learn to teach. So it was just a very different path that I went on. So I was 23 years old, working in banking, and I had to learn mortgages. My first mortgage, I was actually teaching someone in their 40s how they worked. So instead of just learning to do, I had to learn to teach. And that was learning the why behind a lot of things. And that's just carried forward into my career. So over the last many years, when we run into a hurdle where a bank says it can't be done, and I ask why, and they say, because it's policy, I need to figure out why that policy exists. So that's what we're going to explore a little bit today, is the why behind some of the rules that are in place, and then also some ways to get around them. So I'm going to just share my screen for a moment. Here we go. This should come up for everyone. This on your Zoom should be full page, a little white presentation. If it's not showing up full page or you're joining from a phone, you can click on it to pin it to your screen. That might help. So this right here is just the group of companies that we work with. So Designer Capital is our mortgage company. We also are involved in the insurance business and life and disability, the cybersecurity in the financial space, and Envision Developments, which is land use consulting and helping people to design multifamily projects on their property. So tonight, we're going to go through investment property financing, residential properties, which are 4 units or less, the differences between credit unions and banks and where to get financing, the difference in ownership between personally owning it, and you may have heard of owning real estate in a company or a holdco. So we'll talk a little bit about that. We're going to talk about commercial investment properties. These are properties like industrial. We'll go through the different types and just generally how the financing works. And then we're going to get into residential multifamily. So this is purpose-built rentals of 5 units or more. And we're going to talk a little bit about conventional financing as well as financing through CMHC. So CMHC is the Canadian Mortgage and Housing Corporation. And you may or may not know this. They're most widely known for helping first-time homebuyers buy property, where you can buy with less than 20% down, and you can buy a home under $500,000 with only a 5% down payment. But CMHC is also in the business of helping developers build rental housing. So units of 5 units or more, and they can be financed up to 95% of the purchase price. So we'll talk a lot about that and how that works. So to start with, we're going to go through kind of residential financing and talk about some of the myths and pros and cons on there. And we have some tools that I have to kind of do some demonstration work a little bit. So lots of different places. This chart, I've shared this in past events. If you've been at it or we've had a meeting recently, you've probably seen this chart. This chart splits out all the different the main lenders in Canada. There are more than this, but this is a predominant list of all the lenders in Canada. The first column, BMO, RBC, CIBC, National Bank. These are all the lenders that work directly with clients. So if you want an RBC mortgage, you have to get it from an RBC employee. So you have to go to RBC and they'll sell you an RBC mortgage, but an RBC employee can't sell you a CIBC mortgage or a National Bank. So each of these individual banks, they only sell their mortgages directly to clients. This middle column are lenders, banks, credit unions, and foreign-owned banks that have a direct sales force. You can go to Scotiabank and get your mortgage yourself, or they pay mortgage brokers a commission to sell their products. So Scotiabank, TD, Manulife, HSBC, bunch of credit unions across BC and Alberta, and foreign-owned banks. You can either go direct or you can get them through a mortgage broker. And this third column are mortgage finance companies at the top of the list, some banks and alternative lenders, higher risk alternative lenders going into C, and private lending down at the bottom. All of these lenders, they require a mortgage broker to be the intermediary, someone to identify you, collect your documents, share their disclosures with you, etc. So to get access to these products, they have to be purchased or sold by a mortgage broker to give you access to those. So lots of different options. On this list, there's some very big differences between how these lenders look at rental property financing, and we're going to explore that together. So we have a little worksheet, Excel calculator that we use to kind of model some of the differences of these lenders. And when it comes to rental financing, there's a really big difference between credit unions and banks. The main reason for this is the regulating bodies. So credit unions, Vancity, Island Savings, Coastal Community Savings, Ladysmith District Credit Union, Community Savings. Those are some for all the Victoria people joining us that you may have seen around town. They're all regulated provincially. So under the BC FSA, that's the regulating body for the credit unions. Banks are federally regulated. So if a bank has entities or branches in other provinces, then they need a federal bank license, and then they're regulated federally by OSFI, the Office of Superintendent of Financial Institutions. And then there's another governing body that's really important, which is Canada is a member nation of something called BIS. And if you want some really interesting reading and you want to know, someone earlier was asking me about, hey, what's the crystal ball into the future of finance in Canada, and what's going to be a good buy, and what's the state of the economy? We go in and we pull up Google here and we look at BIS. And where we just go into BIS into Google just in general. BIS is the Bank of International Settlements. And this has got some really interesting reading. They're the regulator for all the countries around the world that want to do international banking. So Canada, the US, Australia, UK, etc. So what is BIS? All of that information is in here. And there's some pretty important stuff that they share. And they came out with some rules called the Basel III. And we go in here to Canada. So Basel III is a set of rules where they tighten the rules of all the banks. And this is some really good reading if you want to have an understanding of where the bank policies are going. They're driven by the Bank of International Settlements and the Office of the Superintendent of Financial Institutions have come out with new rules called Basel III. These rules then impact the policies of the banks and potentially at the provincial level, the BCFSA. So Basel III, when they tighten their rules, then they come out and then they say, OSFI, you need to make the banks change their rules to fit. This comes out first, and then the banks follow the rules second. And then the provinces kind of follow the rules third. So when it comes to financing, we sometimes find credit unions have more flexibility because the rules haven't tightened as much at the provincial level that they have at the federal level or that they have at the international level. One of the things about credit unions that makes them a little bit different is credit unions only lend to those who reside in their lending areas, normally where they have branches, and banks lend across the country. So for example, if a bank was lending money and they're lending in BC, there's different vacancy rates. On Vancouver Island, we've had vacancy rates around 1% for the last 15 years. And in other cities like Edmonton, the vacancy rate 2 years ago was 7%. Well, there's a big difference between having a rental property in Edmonton, where when you put it up, you might have to do a paid advertisement to even get someone to respond to your rental at a 7% vacancy. Where for anyone who's had a rental suite here in BC, you put it up for rent, you get 40 people applying basically moments after you put it up. So it's a very different impact when there's different vacancy levels. And if a bank has to have its rules federally across the whole country, they're going to have probably to have tighter rules to represent the communities with higher vacancy rates, because they're going to have the same rules in Edmonton as they do in Victoria, where the vacancy rates and the amount of rents and the reliability of tenants are very different. And some highlights: use in calculation of rental income. Some credit unions don't have stress tests, and non-mortgage debt payment calculations can be different, and maximum number of rentals. So let's quickly look at a case study. So this is a sheet here. It's a little bit small on some people's screen, but I want to share the whole side. So over here on the far left-hand side, there's these two giant green blocks. These represent your debt ratios. And when you're borrowing money, you can borrow 39% of your income with most banks for housing costs and 44% for total debts. There are some banks who have more flexibility on this, but right now I'm going to keep those set as they are. And down here, I've got a box for putting people's income, other debts, and then properties. So let's just do a case study. Let's say someone was salaried making 60 grand and they had a spouse that's self-employed making $100,000 in dividends and $100,000 in dividends in year number 2. And I'm just going to make a 2-year average of this plus this. So in year 3, they make $100,000 at a 2-year average. I click this box So now I've got $60,000 for borrower one and a spouse making $100,000. So we have $160,000 in income. And they have an existing home with a $500,000 mortgage at 4.59%. They have 30 years left on their mortgage. Their payment's $2,600. Property taxes of $4,000. Heat of $150,000. And they have a rental suite in their home of $2,000. And I'm using 50% of the income to be added back. And on this top line is a hypothetical rental purchase. And this property has rent of $4,500. And we're using 50% of the rent. And it's got so $4,000 in property taxes and $100 for heat. If we have a total income of 160 grand and we go to a bank, most banks take 50% of the rental income and they add it back for qualification. So if you had a $2,000 suite in your home and you wanted to know what you qualify for on the bare minimum, the lowest calculation, you'd qualify for a new $635,000 mortgage on a new property if the stress test was 6%. I'm going to put it up a little bit to 6.59 stress test. So in this case, we'd have $600,000 in qualification. Some banks take 80% and they add it back. So if I change this to 80%, it increases this person's borrowing from $597,000 to $733,000. So the lowest qualification was $597,000. And this is CIBC, takes 80% of the rent. Whoops. And let's say over a lender that's taking 50% of the rent, CIBC would lend $136,000 more. Then we have some banks who do, Scotiabank takes 50% of the suite in your home. And they do a 50% offset, but they don't count the taxes or the heat. And they would give that same person $865,000 or $268,000 more in borrowing power. So if you went into Scotiabank, you'd get a very different number for your maximum mortgage than if you went into CIBC. It's $268,000 versus a lower number. Then we also have credit unions that don't count the taxes or heat, and they would be 100% add back on your home, and they don't count your taxes and heat on your home when there's a suite, and they take an 80% or a 75% offset on the new property, and they would qualify the same person for $1,137,000 or $540,000 less than the minimum. So when it comes to financing a rental property right off the bat, that's quite a bit more. On this list here of all these lenders that we have, some of these banks, like Van City, they don't work with mortgage brokers. So if you're going in and you're asking, hey, I'm going to go to a mortgage broker because they have more choice than going directly to BMO or CIBC, when you're going to get your advice, what is the treatment of rental income that they're using? And that could be a limiting factor. So it could be a policy-driven information that you're getting from the person giving you the advice. But here's some of the lenders. So Van City doesn't work with mortgage brokers. They used to, but they've decided to sell their mortgages directly to, they take 90% of the rent and they subtract it off the qualification. And they count property taxes and heat. And where one lender would give someone a $597,000 max with this same information, they would approve them for a $1.3 million mortgage, $715,000 more than say TD taking 50% of the rents from each option. So right there, looking at local credit unions and their options and their treatments of rental income is a $715,000 difference between qualifying. Now, going down to someone's income and looking at this a little bit, self-employed borrowers, in this case, I've got somebody who's incorporated and I'm guessing that they make $100,000. They have a company and they pay themselves $100,000 in salary or dividends 2 years in a row. Most banks take a 2-year average of that. But there's a bunch of banks will also look at the amount of income left in a corporation that someone might make. So if you're self-employed and you're not taking your maximum salary out or dividends because maybe you don't have a lot of debt or you don't need it for living or life expenses, you might have some money left in a corporation. Let's say you had $60,000 left. Banks will often take a 2-year average of the amount of money you have left over under some specialty programs. So Scotiabank has a 2-year average. This plus this divided by 2, and they'll take 60% of that, an extra $3,000 for qualification. And Van City will take up to 100%. So Van City would get this client up to a $1.6 million mortgage, where another lender may only give them $600,000. So there's dramatic differences in the use of rental income if you're dealing with a regional lender versus a federal lender and their interpretation of your self-employed income. When clients are coming to me and we're doing a review of their borrowing power, the first thing we need to find out is taking a deep dive into their income and how which bank is going to qualify their personal income first to find out who's going to look at it in the best way. And then we start looking at their treatment of rental income when buying a property. But there's a lot of people who maybe don't make a lot of money on paper. Maybe they only make $60,000, but they've been fortunate enough to have some money in investments. And in this case, they would qualify for these pretty big mortgages, but the payments are getting up there. That's not going to really give them much cash flow. So we may look at doing investments that are held in different ways. Before I move on from this, does anyone have any questions on? Yes, David.
I was going to ask you, is the stress test still done? Like, I heard somewhere that they scrapped the stress test, or is it going away at some point?
Got it. Great question. So the stress test on a mortgage renewal. So when your mortgage is coming up for renewal, you're at the end of the term. When there was a stress test and you wanted to switch banks from TD to Scotia, TD, to just simply sign the paper and renewal, you didn't have to requalify. And if you wanted to move to a new bank, you not only had to qualify, but you had to qualify at 2% above the rate that they were giving you. So they were at a dramatic disadvantage for qualifying. What's happened is the federal government clarified that if you're not asking for any new money and your mortgage comes up for renewal and you want to move to a new bank, the new bank does not need to use a stress test. You still need to collect their income and documentation to make sure that they qualify, but they're qualifying at the actual rate that they're getting. The stress test impacts your qualification by about 20%. And that removing that stress test increases your borrowing power by 20%. So let's chat about some lenders that really have some superpowers when it comes to rental property financing. So let's say you wanted to buy a second home. You had an existing mortgage of $500,000. There are on this list some lenders that have some really big superpowers. So Van City uses probably the highest percentage of rental income for qualifying of anyone else. and has no limit on the amount of properties. That makes them very special. Another lender that has really big superpowers is Interior Savings. So Interior Savings has a rule where they don't need to use a stress test. So they can use the regular rate. Unfortunately, when they use their no stress test product, the interest rates on their mortgage are a little bit higher. They're coming in at, around 5.29%. And they can actually do an amortization of 35 years on a rental. And so they would qualify someone with the same $60,000 in income for around an $891,000. And if we had both those borrowers on here, they're up at about a $1.6 million qualification. So they're kind of special. So if you're running into, looking at taking some money out of a rental property, or you want to buy another rental property, there's some lenders out there that have very different rules for calculating it. 35 years and no stress test, getting the mortgage amount up to 1.597 million, and they might lend someone $1 million more than the bank you might be talking to. That's a huge difference in their qualification. Van City has a rule where if you're doing a refinance, they don't have to stress test the old money. So let's say you had $500,000 owing on your property and you had a couple rentals and you wanted to take $1 million out to buy another property because you had a ton of equity in your home. They don't have to stress test the 500,000. So you'd qualify at say 459 as a rate. And then you'd only have to have a stress test on $1 million at the stress test, which is 6.59%. So versus another bank, it would have to qualify you at that whole amount. So those are some of the superpowers. The other one here is if you're buying a property, a rental property, and it's a condo, Scotiabank, when they're doing their calculation, they don't use fees, taxes, or heat in their calculation, but they only count 50% of the rent. So if you're one of those people who's unfortunate enough to have bought a property where the strata fees have gone way up, but you're not getting a lot of rental income, Scotiabank's qualification might end up being very beneficial. So if I go into that sheet and we look at this home staying here, but you've got $1,500 in rent, $500 for strata fee and taxes. And I'm going to go in here and go 6.89% as a qualifying rate over 30 years. And let's say you only had a $60,000 income. If we were going to a lender with a 90% offset, that would get someone 243. We're going to a lender that used 50% add back. They'd qualify for a negative mortgage, where they would say, hey, you don't qualify at all. But Scotiabank would come in here with the 50% offset, and they don't count the strata fees, taxes, or heat. And we'd still end up in the negative a little bit, negative 300 grand. So in this case, with this low rental income, a credit union is still going to be better. Bad example to use for this, but they don't count strata fees. So we have some situations where if someone had around $1,000 strata fee, they're much better off going through Scotiabank. So going back, use of calculation of rental income can make credit unions or banks differ widely, with local credit unions probably being the winner when it comes to rental income and financing things regularly. And some of them have different payments that they'll use. So Van City also takes the interest only payment on your line of credit, not a principal and interest payment, and that can increase your borrowing power quite a bit. Another thing that we can look at doing is personal versus a holding company. So some people have their money in, if they're incorporated, they might have a holding company that they hold money in. And they may say, hey, I'm going to buy my real estate in a holding company because that's where the down payment is. Well, some of the benefits of that is we can separate out the liabilities. So if you buy property in a holdco, most banks can finance those at regular residential rates, but then other lenders may ignore them in the future. So if I look at this list here of lenders, Scotiabank, BMO, RBC, CIBC, National Bank, TD will all lend to help you buy a rental property inside a holdco and give you residential rates. And they also use your personal income for helping you qualify. So you qualify very similar for the same amount, whether you own it in your personal name or a holdco. But after the property is purchased, credit unions would not count that property anymore. So an example, if you bought a property in a holdco and it had $1 million mortgage on it, and you were this couple that had $160,000 in income, and you had $1 million mortgage, and it was at 4.59%, just because that's up, you'd have a payment of $5,094. Say it was about $6,000 for your property taxes, $150 for heat, and let's say you got $6,000 in rental income from that property. And we're going to go in here and go 80% offset. So if you're holding that property there and you have your primary residence, when you finance this and we look at going to other lenders, credit unions don't often count this debt as if you own it, and it's as if it disappears and gives you more borrowing power. So with this property here, you qualify for $500,000 for an additional purchase later on. But if you look at structuring some of your assets in a holding company, and we then go to a credit union for your next purchase, but we finance the holdcos through a bank, when we end up removing those, it increases your borrowing power by about $150,000. So sometimes we interchange banks and credit unions for putting together a portfolio of property ownership. Right now, however, it hasn't made a lot of sense to buy residential properties as rentals in the province of BC. Most of them have had, if you put on a mortgage or you put a 20% down payment, they're losing money on an income basis. And in order to make, normally you buy a rental property because you want to make cash flow. We haven't been seeing that for the last 2 years since prices went up and then rates have gone up as well, that people aren't making positive cash flow. So for people financing rentals, trying to figure out maybe how to take equity out, we can explore rental policies through credit unions to see if we can get you access. But for most people, we're actually moving away from residential real estate and into commercial investment properties to get a yield on your investment. Now, when it comes to financing commercial investment properties, they're very different. So they don't look at your personal income for qualifying, and instead they want to see the property qualify for itself. So commercial investment properties, some examples of those would be mixed use, which is properties that have more than 30% non-residential in them. So maybe a ground floor of commercial, 2 or 3 tenants, but they can sometimes have residential property above. Office space, retail, industrial, and multifamily. Although we're going to cover multifamily in more detail later, because that's a big part of the presentation tonight. How does commercial financing work? Well, as I was saying, they ignore your personal qualification. So they don't look at your personal income and your personal debts. You could have very low personal income and a very high mortgage, and the bank could say, hey, you don't qualify to buy any more residential property, but it shouldn't impact your ability to buy commercial property. There's some different calculations that are required. Normally they want to see that you have net worth. They want to see normally about 40% to 50% of the loan that you're buying. So if you're wanting to borrow $1 million, they want to see that you have an outside net worth of $500,000. and that can be in equity and other real estate, and that you have some experience in managing tenants or in something that would relay well. If you've never owned a rental property, they might say, hey, we want you to hire a property management company that has experience renting it. What we're going to go through real quick is a really important calculation. The qualification is based on net operating income, or NOI. And then they want to see that the property can cover itself, which is referred to as a DSCR, or a debt service coverage ratio. So what is NOI and DSCR? So when you're buying commercial property, the simplest way to understand this is something called a triple net lease. So when you're buying, let's say, a warehouse or a commercial space, you can rent out the property in a couple different ways. And one of the ways that people rent it out is a lease called a triple net lease. And that's where the tenant pays a base rent plus all of the expenses related to the property. So the way that you calculate the net income from that property is simple. The NOI is you take the triple net lease, and the only thing you need to take off is the vacancy rate. So for example, if you had $5,000 in triple net income, you take off 5% vacancy rate, and you have a net operating income of $4,750. Another type of lease, this is more similar to how residential leases are written up. Your tenant pays a gross amount of rent, and then you as the landlord tend to pay some or all of the property related expenses. So in a rental arrangement where the tenant pays rent and the landlord pays all the expenses. So the NOI in these cases, the lease income minus vacancy, and then minus the operating expenses. So for example, $5,000 in rent, minus 5% vacancy, minus $1,250 for the property taxes, insurance, utilities, repairs, maintenance, etc., leaves you with an NOI of $33,500. This is important because sometimes when you're looking at commercial property listings, you need to know whether they're talking about a triple net lease, $5,000 a month. That would mean about $4,700 in rental income left for making your mortgage payment. Or if it's a gross rent and you're expected to pay the other expenses, because that leaves you with a lot less rent. The way commercial lenders look at these properties, they want to see the NOI, the $3,500 and the $4,750, cover at about 120% to 130% of the loan amount, meaning they want to see you with positive cash flow. So an example of a 1.25 debt service coverage ratio, which is the halfway between the two, they want to see an NOI of $1,250 for every $1,000 of debt payment. So if you had a triple net lease of $1,300, you'd have around $1,000 of mortgage that it would cover. On commercial standard property of those asset classes, other than multifamily, standard amortization is 25 years. The rates are between 5 and 6%. So for example, a $1 million commercial loan at 6%, over 25 years would be a payment of $6,398. So if you were looking at a property that you wanted to get $1 million mortgage on, you'd need it to show that it had an NOI of at least $7,998. So a triple net lease in place of $8,000 to be able to service $1 million mortgage. Standard financing, most banks and credit unions will loan you 75% of the purchase price or the appraised value, whichever is lower, which means you need a 25% down payment. This again is an asset class, hasn't been that hot. Mixed use properties have been sitting, office spaces have been sitting, retail has been sitting, industrial has been sitting. But the thing that's been a really big boom lately is multifamily. And that's the main part of this today. So going down into multifamily. So multifamily, the reason that I wanted to cover those other parts first is it's much easier to understand the rental income when you think about a triple net lease. You got $5,000 a month, minus some expenses, and that'll cover a certain amount of debt. On a multifamily, yeah,
Can we take a question before we move on to multifamily?
yeah, go for it.
Okay. Shashi asks, what benefit does the no stress test now have for homeowners? You said no change to mortgage amount, right?
Yeah. So it's the competition between the banks. So previous, if your income was the same as it was when you qualified for a mortgage, so if your life was exactly the same and you barely qualified for a mortgage, you bought at the maximum price and you were coming up for renewal, if you stayed at your bank, you didn't need to qualify. But if you moved to a new bank, you had to qualify at a 20% higher qualification rate because they were adding a stress test to it. And so a lot of people didn't qualify to go anywhere but stay at their existing lender unless they had a 20% increase in their incomes. So by getting rid of that rule, people can now move banks much easier because you don't have to qualify to stress test for the new money. So it's increased competition for your mortgage renewal. It's much easier to move your mortgage from bank to bank. If your mortgage was CMHC insured, that was already the rules for the last couple of years, that you didn't have to requalify to transfer a mortgage. But now they've come out and clarified that you don't have to do it with a mortgage if you have a low ratio mortgage as well. So it's increased qualification and ease of transferring your mortgage between lenders. That's the big benefit there.
Awesome. Did that answer your question, Shashi? We'll assume it did. He'll respond, I'm sure. Okay. Thank you, Tyler.
So the meat and potatoes of today is multifamily financing. So the government's come out with a program that's pretty cool. Before, when you bought an apartment building, it was an asset that was restricted for really only the rich because you needed a big down payment on an apartment building. You thought coming up with 20% down on a house was a lot of money. Think about coming up with 25% of an apartment building. So a $10 million apartment building, you needed a 25% down payment or $2.5 million. Way out of reach for your average person. And it had to have really good cash flow in that building for you to get the mortgage of 75%. Because on a conventional, without CMHC, they wanted to see the building cash flowing at 120%. They'd finance you up to 85%. And they gave you 30 years to make the payments on it, which was tough to do and tough to find property. So a lot of rental apartment buildings were selling between large groups and funds called REITs, real estate investment trusts, which was a pool of money, sometimes traded on the stock market, sometimes privately held, where they sold apartment buildings between each other. And they were the biggest landholders. CMHC has had a standard rental program for a long time, and they would finance up to 85%, which made that a little bit more achievable. So if someone wanted to buy a $10 million apartment building, they needed $1.5 million down instead of 2.5, narrowing the gap. And they would allow 40-year amortizations, which made the payments lower, which made achieving those better. And the interest rates are lower, 3.75 to 4% versus standard rental housing, which is 4 to 5. So that they start to cash flow and it starts to make sense. CMHC's recently changed this program that if you buy a new build or you're building a new construction building, you can go up to 50-year amortization under their standard program, which makes the payments much lower. But the hot topic is a program called CMHC MLI Select. And it is, all you type into Google is MLI Select, and it'll take you to the CMHC website. Oh, bad gateway, interesting. So this is the reference guide, CMHC MLI Select. And it stands for Mortgage Loan Insurance Select. But it's a new set of parameters to incentivize developers to build more rental housing and to incentivize people to buy them and also to comply with the program. So it basically has some different points so that if you score different points, you get different qualification on your building. And we'll go into those in a minute. But right here is my presentation. So on a $10 million building, they can finance up to 95%. So to buy a $10 million apartment building, you only need a $500,000 down payment. That's less of a down payment than people need to buy a $1.5 million house in Victoria in a lot of cases. You know, you put down a $500,000 down payment, you get $1 million loan. The house you buy might not cash flow. But this government programs come out where they'll finance 95% of the purchase or building of an apartment building. So as little as 5% down. Again, the property has to cover itself, so the down payment is restricted to as long as the property covers. The coverage ratio is 1.1%, so it means it's easier to qualify. And they use 27% expenses for a new building and the actual expenses if it's existing. And the rates are as low as 3.75 to 4%. So if I go into this calculator here for this example and I make this a little bit bigger, and let's go into Zoom view, Zoom 200%. So I'm going to go over to this calculator here. We'll look at these payments. If you had a well, let's just use $1 million payment for comparison. $1 million loan on a rental property, residentially, 4.59% over 30 years would be about $5,095. If this was a CMHC insured loan on an apartment building, the rate's lower and you can get up to 50 years, making that payment much lower by $2,000 or $1,420, meaning that the cash flow is much better. The reason that they've done that, come out with 50 years, they're wanting to incentivize people to be able to allow either handicap accessibility to be added to the construction of the building, to be able to have below market rents, or to be able to build buildings that are more energy efficient, or to buy a building and to do energy efficient upgrades to it. And that's the incentive that they're putting on. So at a 50-year amortization, it drops the payment. If we go up to a $10 million loan, of which you only need technically $500,000, and I'll get into some of the other qualification in a moment, and the rate's 3.75, the payment's 36 grand, which we'll talk about what type of rents you'd get out of a $10 million apartment building, etc. But that's kind of where we're sitting, it's $36,000. Whereas before this program was introduced, interest rates right now would be about 4.85%. And traditional banks like to give a max of 25, 57,000. So we're talking about a $20,000 difference in the qualification or the cash flow of an apartment building. So this new program is revolutionizing the rental and the apartment building program, being that when you go from 25 years to 50, and it's insured by the government, so the bank doesn't take any risk on the interest rates, it's improving the cash flow by so much that these assets all of a sudden start to work again with, if you're buying an existing building with lower rents, you don't need to increase them because with the government insurance and longer amortization, these assets are still cash flowing. So going back into the presentation a little bit. So MLI Select, it has some requirements. So in order to qualify, a property needs to have some social outcomes: affordability, energy efficiency, or accessibility. And each one of these has different points that you achieve. And I just want to go to the Better MLI site here. So I'm just going to make this bigger. So if you're building or buying a brand new building, you get different points. So on new construction, if 10% of the units are below 30% in the median renter income for the area, as published by StatsCan, or level 2, 15% of the units gets you 70 points. And if you had 25% of the units, gets you 100 points. For existing properties, so like, let's say you found a 20-year-old apartment building, the thresholds are higher. They want to see 40% of the units to get 50 points. So in a 10-unit building, they'd want to see 4 of the units at 30% of the median renter income. The median renter income, there's a tab, I'm not going to pull it up right now, but it shows all the different cities across Canada and what the rental incomes are. And in Victoria, the median renter income is $40,000, and 30% of that works out to around $1,222 a month. So if you're buying an old building in Victoria and the rents in the building are $1,200 or less, and 40% of them, 4 to 10, are below $1,200, then you get 50 points for that building. On existing properties, affordability doesn't normally work all that well, but on a brand new building where you only have to do 10%, so 1 out of 10 units, you'd rent at $1,200. And it can be any size unit. So a studio that's 500 square feet, they would normally rent for $1,600. You could discount your rent to $1,222, and that would get you 50 points in the program. Energy efficiency, if you're building to 20% better than the National Building Code, 25% or 40 points gets you different points. If you hit level 3, it gets you 50 points. Existing properties, if you improve a 40% decrease over the current baseline, you get 50 points. So with older buildings, most people are targeting doing energy efficient upgrades, because if a building isn't very efficient, let's say it has an old boiler, old windows, incandescent lights, and you just go in and put LEDs in, maybe replace some leaking single pane windows, it's very easy to increase or decrease the current baseline by 40%. One person, it was just doing LED lights and replacing 3 single pane windows for a total of $12,000 in improvements to get a 40% increase for the points. And then handicap accessibility, 20 points for hitting level 1 and 30 points for hitting level 2. Then this talks about what you get. So on an existing property, if you hit 50 points, you can borrow up to 85% of the purchase price and have 40 years to pay it off. If you hit 70 points, you can borrow up to 95% and you have 45 years. And if you hit 100 points on an existing building, you get 95% financing and have 50 years to pay it off. On newer buildings, so in Alberta, there's a lot of these where people build them and put them up for sale before they're complete. And in Victoria, with the missing middle, there's probably going to be a lot of sixplexes going up. Minimum 50 points, you get the full 95%. So with only hitting 50 points, you still only need 5% down and you get 40 years. If you hit 70 points, it's 95. If you hit 100 points, you get 95% financing in 50 years. What this is allowing is, for example, you could build a brand new sixplex, hit step code 3, which gets you 50 points, and they'll give you 95% of the cost of the project and 40 years to pay it off. Now, 40 years might not be enough to get the full 95%. You might need to put 6 or 7% down to pay it off over 40 years and have it cover itself. Or you might look at, hey, maybe I'll make some of the units handicap accessible and I'll get 45 years and then I only need 5% down. So if you're building or buying new, we can help analyze what program and how many points fit. And if you made 10% of the units affordable and hit step code 3, then you get 100 points for doing that. And you get 50 years on a building, making these cash flow right away. What we did was we put together a little bit of a calculator here just to show an example of a building. So this is a tool that we use to underwrite buildings. So we have a whole bunch of things when we put together these applications. So we fill out how you own it, the CMHC fees, the timeline of applying for financing. This is someone building it. These are all the costs that this person's spending to build it. All personally identified data has been removed from this, but in this case, this person's building in a $11 million apartment building with 13% down. They're not actually putting 13% down. They just bought the land and it's gone up in value. So they're actually building this with no new money in. They just bought the land for 500 grand. And now the land is worth $1.2 million, which is increased in value.